Hey guys, let's talk to you today about a plan that I believe can be extremely beneficial in your retirement planning. And just like any plan for the future, it's like planning a road trip. And when you plan a road trip, you always have to have an alternative plan in case you hit an unexpected bump in the road. And that's what we're going to be talking about today. Before we get into the plan specifics, let's target who we are speaking to. We are speaking to folks that are 50 and above and have a time horizon of at least until they are 60, until they can be interested in withdrawing income. All right, so if you're below 50, no good. If you want to start withdrawing money before 60, no good. 50, 60 is who we're targeting. Okay, now, what are the biggest challenges facing retirement planning investors today? Number one, fear. Everyone is afraid of when is the next 2008 coming. If you're 50 and above, you certainly remember you were in your 40s when 2008 came and you lost a significant chunk of retirement portfolio value, right? You had 100 grand, most likely. At the end of 2008, it was probably somewhere around 70, maybe even 50-ish, depending on what you were involved in. Now, let's think about 2007, the time coming up. When things are going good, most people just are on autopilot. They're not paying attention. They're like, yeah, I'm fine. Everything's good. Market's doing well. But when the stuff hits the fan, right away, we start to panic. What do? Do we sell? Do we wait? Right? And these are the things that people forget about. Because, again, we're in a good period right now where it's been quite a while. We'll talk about that in the next slide. If you look at 2008, the Dow made its second fastest jump between 1,000 point milestones in 2007. And then it crashed. So there was really no way to believe what was going to happen in 2008. Of course, there were some experts, and I'm sure you've seen some documentaries, but for the most part, everyone was caught off guard by the disaster of 2008. Now, here's a great statistic, something to really ponder. On average, every 3.5 years, the stock market declines 20% or more. Think about that. So since 2008, there has not been a market decline, even remotely close to 20%, going on 10 years. Pretty interesting. Now, let's look at some of the reasons why the market may react. This is going back to 2011, right? You see some investors rattled by the uprising in Egypt. You see commodity prices. You see Japan. Markets tumble over U.S. debt problems. European debt crisis in Greece. Combination bad news from U.S. and Europe causes markets to crash. Right? Let's look at today. What 2018 issues could affect the market? Of course, terrorism is always a threat. How about the newest challenge, the trade wars, the tariff potential between China and the United States? You have news media. Here's a guy that broke a false report. If you remember, this was back a few months back. He mistakenly reported on Michael Flynn, and it caused the market to tank for that day, if you recall. It's like 400 or 500 point drop, and the news wasn't even real. So the media can certainly affect the market. And of course, this guy, whether you like him or not, the reality is him becoming president affected the market in a positive way, right? Regulation cuts, tax cuts, corporation-friendly policies. But let's be honest, any one of these things that you see on the screen can cause a problem in the market. I mean, he's not liked. He's hated. Anything he says basically can affect the market in any way, good or bad. So these are the things that investors worry about going forward. How would it affect their retirement? Of course, the Federal Reserve, and that leads us into number two. Like, you think about the number two issue is no risk, no reward. Okay, forget all the fear. I'm afraid of all of that. I don't want any of that. Problem is, where are you going? You got to put all your money safely in a bank where your interest rate average is not even 2%. I mean, you can't possibly sustain long-term retirement income on a growth of 1.4%. And even if and the rates are a little bit better now, 2.5. I mean, it's just not enough. Number three, how much do I need? Why do we have a problem with this? Because right now, you have a 50% chance that somebody's living to age 93. Doesn't mean you're going to be healthy to 93. In fact, a lot of people aren't. But because of medicine, modern technology, and all that good stuff, we're living longer. So you're going to need more money. Problem is, we don't know. We don't know how long you're going to live. So what do? Investors are confused. All right, listen, I want to be... you're telling me I have to take some risk because if I don't, I'm not going to get anything. But then I could lose. So what are you telling me? What do? Do I buy a stock? Well, remember this company? The employees of this company had most of their retirement income in this stock. It was a $90 stock. It was one of the largest companies in America. It went from $90 a share to zero in months. So we don't recommend buying one stock to rely on your retirement. Do we go here? We talked about this already, right? I mean, this is a recent screenshot of the CDs. This is a 150th anniversary special. A 1.26 whopping percentage. I mean, no, this isn't the answer neither. Now, here's the program that I believe is a great middle ground. It's called the Power Advantage 10. And it's available through AIG. And AIG, take a look on the right, one of the largest insurance organizations in the world. They go back to 1919. Statistically strong in every category. Financial strength, high. And that's very important whenever you talk about the program I'm going to talk about, which is an indexed annuity. Whenever you talk about an indexed annuity, you want to do so with a very reputable, strong financial company. Now, here's some of the things that the Power 10 offers you. Okay? No loss of principal. Think about that. No possible loss of principal. No loss of earned interest. No emotional ups and downs. And on top of that, an extremely low fee. You get a bonus. Right now it's at 3%. $100,000 immediately is $103,000. Not bad. And you have guaranteed lifetime income regardless of how long you live. So, low fee, less than 1%, bonus currently at 3%, and lifetime income no matter how long you live. I want to show you this hypothetical 10-year view. Try and follow along year by year with me on this. And first, let's recognize again that we have a couple of factors. I just underlined, if you see that second middle column there, you see income-based guarantee 7.5%. So we're going to assume this is someone investing $100,000. So remember I said a bonus? So if you look in the blue section, you see $100,000 plus a $3,000 bonus. Now you see two columns here. You see actual account value and you see income-based guarantee. And you see 7.5%. Okay? So keep in mind, 7.5% of 100,000 is 7,500. Now, we're going to run some hypotheticals. Okay? Take a look at first year. Just circled 10%. Let's say your account value, and then we'll talk about the vehicle on how to achieve this, but let's just go with this first and then we'll go to that. Let's say the vehicle we select gets us 10% in that first year. Well, take a look. 10% increases our initial investment plus the bonus to $112,321. Now, column number 2, you'll see the same exact figure. Now you say, what's going on here? Why do I have two figures? Well, I'm going to show you why we have two figures in year number 2. And let's go to number 2. You see what happens here? This is a 3% year, right? So your actual account value goes up 3%. It goes to $114,827. But remember the right side where it's guaranteed to increase by $7,500? Well, that's what happened here. Because you did not achieve more than that 7.5%, $7,500, the income base on the right increases by the $7,500. So your $112,321 goes to $119,821. So you see two different figures. Actual account value on the left and income base on the right. And I'll explain to you the difference of these two as we go along. Now let's look at year 3, which is a bad year. Market loses 8%, right? Oof. All right, bad. However, I just underlined this one. You see how this number here is only 113,642? Well, you say, Bob, that's a lot. That's not an 8% loss. That's basically like a 1% loss. Yeah, well, remember, see this fee I just circled up at the top? The fee gets reduced from your account value every year. That's the most you can lose from year to year. You cannot lose more than the fee. Remember we talked about in the previous slide, no loss in principal, no loss in interest earned. You are locked in. That 114 number cannot be lower only by the subtraction of the fee. And that's that figure that you see here, the 113,642 on the left. However, on the right, we have the automatic increase of 7,500. So you see that figure goes to 127,321. Let's look at the next year, another bad year. See, market or account value went down a little bit. Subtraction of the fee. However, income base rose by 7,500. We have another bad year. Market value is reduced by the fee. However, income base rises by 7,500. You get the gist? And now we have 3 straight good years. Okay, so you see the account value actually increases based on the return. But the income base continues to rise 7,500 more because that figure is higher than the figure on the left. We have a slightly bad year in year 9, and then we have a so-so year in year 10. Now, take a look at that figure, 200,000 there. Here's a nice thing about this program. If the person has a 10-year horizon where they do not need to take any withdrawals, the income base will guaranteed to be double of what it started. So you started here with 100. The income base goes to 200,000 if you did not take any withdrawals up to this point. Okay, now I want to throw another column to the right. What column is that going to be? That's going to be a traditional investment. If you were in a traditional investment that had no fee whatsoever, and you got the same exact returns as we projected here in this 10-year horizon, your 100,000 10 years later would be worth 98,472. You would have lost 10 years and basically lost a couple of $1,000s. Okay? Now look at the three differences. Because now we're going to get into this. Now what? You got, if you were all the way on the right, you would be like, oh boy, this is not what I planned. However, if you're in the power 10, you've got $146,388. You could take all of that. It's all yours if you wanted to do that. But here's the sweet thing. You can start drawing income off this figure of $200,000. Even though you don't have $200,000, that's the figure that's going to be used to draw income from. So what does that mean? Here's what it means. If you're age 65 at this time, it means you can take $10,000 a year for life, regardless of market fluctuations or your account values. Okay? Now, live to age 85. That means you've taken $200,000 of income on a $100,000 investment, fully guaranteed. You never had to worry a lick. All right? Market tanks 3 years, 4 years, whenever. It doesn't matter. This money is completely guaranteed. And if you happen to die at any time during, a designated beneficiary would receive the remaining account value. That is the beautiful feature of the Power of 10, flexibility. Now, I'm not going to get into all this because we can do this in person, but there's 4 basic account buckets that we like to say that you can choose in the Power of 10. You can choose a fixed interest account. You can choose the S&P index, the ML Strategic Balance Index, or the PIMCO Index. Or you could do a little bit of all of them. You could do 25, 25, 25, 25, 30, 20, blah, blah, blah. Total flexibility. Now, I want to give you an idea of how this concept works. Let's just assume that we're doing the ML Strategic Balance Index and that we're going to utilize a spread. Because people say, Bob, this sounds too good to be true. I can't lose any money. The fee's very low. Lifetime income. What's the drawback? Well, the drawback is you're giving up on the big score to stay protected, but yet you're not completely out of the game. You're not sitting in a CD where you know you can only get 1 or 2%. You can still gain in this program, but you are going to give up bigger upside. So let me show you an example. Take a look at this. We're going to assume a 4% spread. All right? And we're just going to draw some random numbers here. We're going to say, I want you to go to number 1, where I got the blue arrow. Let's say this was the MLS Strategic Balance Index over a 12-month period that you started the contract. And each month, as you can see, the number is tabulated on what the index is. So nothing's getting credited until the end of the year. Okay, so every single month, it takes note of what the index is at the date of your anniversary. Okay, so what we did here is we totaled up the 12 months, as you can see on the left, number 1, where the blue arrow is pointing. The sum of the 12 monthly index closing values equals $12,855. Okay? Now, number 2, we divide that by 12 and we come up with an average of 1,071. Now we take that 1,071 and we compare it to the starting value, which was $919 in this example. Okay? Now, that's 16.5% higher than the starting value. Now let's go back up top. We subtract the 4% spread from 16.5 and we come up with 12.5. Boom. So if this was the scenario in your 12-month period, your account value would get credited with 12.5%. Okay, now, again, I'm a baseball guy. Maybe you're not. But these are 2 of the most prolific home run hitters in baseball. This is Aaron Judge and Giancarlo Stanton. So, because people, again, I want to address the negative to the plan, the cons. Well, the con is, let's say that year that I just described to you, the S&P might have did 20%. And you only got 12.5. Well, that's the trade-off. You're giving up the home run. These guys hit lots of home runs. They hit over 100. In fact, I believe it's 110 they hit combined last year. But you know what else they did? Is they strike out a lot, more so than any other players in the game. And what's striking out when it comes to the market? It's bad years where, oof. So you do not have the possibility of striking out, but you're also giving up on the home run. Does that make sense? Hope so. Protect your principal with the power of zero. If in 2008 you lost 38% in a traditional, if you were invested in the S&P 500, you lost 38%. Imagine if you had the ability to just have your account value stay exactly the way it was the prior year. Imagine what that would have done to your long-term investment horizon. Think back if you were in the market in 2008, and let's say you had 200-300 grand in your 401k, and you lost 70-80 grand in value. What if you had the ability to not lose anything and go back to zero? That's the Power Advantage 10. It does that, and the impact can be dramatic. Could you afford a lost decade during your retirement? Here, listen, we talked about this already, but I thought this slide's important to reiterate. This is an actual 10-year horizon. If you look below, 2001 to 2010, that's a traditional investment of 100,000 is worth 95, and you've lost 10 years. Where if you were in the Power 10, you'd have 140,000. So I think we've beaten that dead horse. Now let's talk about the monies that are great for this program. 401k rollovers are awesome for this program. You left a job and you don't know what to do. Do you want to keep it in your old 401? Why? Why would you do that? You get away from the company, pull it out, turn it into an IRA. This is a perfect place for that, especially if you're concerned. If you're a risky guy and you say, I just want to let it ride. Okay. Good luck with that. IRAs. Some folks have IRAs in all different types of places. This is a good spot for an IRA. Cash that's not needed. Well, who the hell doesn't need cash, Bob? What I mean here is a lot of folks have shoebox money. They don't plan on touching it, but they're afraid to put it anywhere because they don't want to lose it. But they have no intentions of touching it, at least until many years. You can put cash into this program. Supplemental plan. It doesn't have to be your primary plan. You might still have, and you might still be active working. You might have a very lucrative 401k at your job. You may have a guy that already does a lot of your stuff. You might be a stocks, bonds guy or gal. You might like to buy and trade stuff. That's fine. Nothing wrong with having a supplemental plan. People sometimes say, well, I got a guy. You have an ailment. You have something wrong with your knee. Chances are your primary doctor is not going to be the one to operate on your knee. You're going to go to a specialist. There's nothing wrong with having a couple of different folks help you with finances. If you have a guy that does your stocks and he does your trades, cool. Nobody's going to say drop him. But there's always room to have a supplemental plan, especially one that has guarantees. And if you're, like we talked about this already, but this is for home run free funds. This is not something where you're looking to make big scores. You're looking for safety. You're looking for a retirement supplemental plan, income, guaranteed lifetime income. It's not something where you're going to say, I'm going to get rich on this. This is not. This is going to protect your funds, and it's going to allow you to have peace of mind knowing that you never really have to worry about the market again. So that's the plan, kind of the high-level overview. Be happy to get into specifics with you. Look forward to hearing back from you. Thanks for listening.